Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and a warm welcome to Money Talk on Wednesday the 27th of September. It's the middle of the week in the final week of the third quarter. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And thank you for making this podcast one of the most listened to financial podcasts in Hong Kong and Singapore. In today's business and finance headlines, the crisis at China Evergrande Group has deepened after the company's mainland unit confirmed it failed to repay an onshore bond. The mainland property developer said its subsidiary, Hengda Real Estate Group, defaulted on a 4 billion yuan in principal plus interest due to September the 25th. In a statement Monday, Hengda said it would actively negotiate with bondholders to find a solution. Hong Kong's exports in August posted their longest streak of monthly declines on record as demand remained weak and China's recovery faltered in the face of further declines for the property sector. Exports from Hong Kong dropped 3.7% year on year to $358 billion, easing from a 9.1% fall in July, and it marked a 16th consecutive month of declines. US consumer confidence declined for the second consecutive month in September as people's short-term outlook for business, the labour market and income conditions worsened. The Conference Board Consumer Confidence Index declined again in September to 103, down from an upwardly revised 108.7 in August. Expectations fell back below 80, which is the level that historically signals a recession within the next year. Global equities sold off on Tuesday as investors braced for interest rates to be higher for longer, while the dollar jumped to a 10-month high and Treasury yields hit new 16-year highs. At the start of September, traders were betting that US interest rates will be 4.2% by the end of next year, implying as many as 5 standard interest rate cuts. Now traders in the futures markets are expecting rates to be 4.6% by the end of 2024, implying 4 cuts or less. The Fed's dot plot of future interest rate projections by Fed officials shows they are forecasting just 2 rate cuts in 2024. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Louis Kuijs, Chief Asia Economist at S&P Global Ratings. With a view from Japan is John Beirne, Vice Chair of Research at the Asian Development Bank Institute. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. You can send any questions or comments there, as well as finding my daily newsletter with more business and finance news from across Asia. On Wall Street, US stocks were lower as data on consumer confidence and home sales showed the US economy may be finally coming under stress from the sharp series of interest rate rises. The S&P 500 slid 1.5% to 4,274, closing below 4,300 for the first time since June the 9th. The Dow lost 388 points, or 1.1% to 33,619 in its worst day since March. The index also closed below its 200-day moving average for the first time since May. The Nasdaq Composite pulled back 1.6% to 13,064, and the Nasdaq Composite is down nearly 7% in September, while the S&P 500 has lost more than 5% in the month so far. The yield on the benchmark 10-year US Treasury was up 2 basis points at 4.56%. That's a new 16-year high as bets increase that interest rates will remain higher for longer. Yields on the 30-year note added 4 basis points to 4.69%. That's the highest since 2011. The move up in rates helped propel the US dollar higher. The US dollar index rose 0.2% to 106.17 and hit its strongest level since November last year. Sterling fell to a 6-month low of 1.215 against the dollar on Tuesday. The Japanese currency sank 0.1% to 149 yen against the dollar. That's the lowest level since October 2022. The Chinese yuan was flat at 7.31 renminbi versus the dollar. Hong Kong stocks continued their slide. The Hang Seng Index tumbled 259 points, or 1.5%, to a 10-month low of 17,470, and the index has lost 7.7% so far in the third quarter. The tech index lost 1.7%. The Hang Seng China Enterprises Index fell 1.6% to its lowest since November the 29th. On the mainland, the Shanghai Composite dropped 0.4% to 3,102. Property stocks continued to slump after China Evergrande failed to repay an onshore bond and was unable to meet regulatory requirements to issue new bonds. Shares of China Evergrande, which plunged almost 22% Monday, tumbled another 8.1% on Tuesday. The Hang Seng Mainland Properties Index fell 1.3%, and it does look like we're going to see further falls at the open. Futures markets are projecting a decline of another 50 points or so for the Hang Seng. That's about 1/3%, projecting the open to be about 17,415. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On this Wednesday morning, let's welcome our regular weekly commentator, Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Morning, Enzio.
Morning to you, Peter.
And also joining us is Louis Kuijs, Chief Asia Economist at S&P Global Ratings. Welcome back, Louis.
Morning, Peter.
Let's start in Hong Kong. Hong Kong's exports in August posted their longest streak of monthly declines on record as demand remained weak and China's recovery faltered in the face of further declines for the property sector. Exports from Hong Kong dropped 3.7% year on year to $358 billion. That's eased from a 9.1% fall in July. It was also better than the median estimate of economists for a 6.1% drop, but it did mark a 16th consecutive month of declines. That's a record streak, longer than the streaks recorded during the Chinese stock market crash in 2015 and 16 and the aftermath of the Asian financial crisis in the late 1990s. Among major destinations, exports declined the most in South Korea. They were down 35%. They were down almost 21% to Taiwan and 20% to Japan. Shipments to mainland China fell by 1.5%. And imports, they fell 0.3% year on year. That eased from a 7.9% drop in July. And among trading partners there, purchases dropped largely from Malaysia, down by about 37%, and they're down about 15% from Vietnam. From mainland China, they were up 4.3%. Enzio and Louis, what does this tell us? I mean, does it tell us more about overseas demand than Hong Kong, or what does it tell us about both?
Well, I think it's in the context of my economic clock, it's just saying that the global economic time continues worsening. We have an excess demand for money and an excess supply of goods, which is intensifying. Indeed, going back to Louis' home country, Holland, in their most recent trade monitor, trade volumes in July were down by an annual 3.2%. But I think one key reason for this on the Hong Kong side is because of a major displacement of China trade. China, as we all know, has been a boom man in the US. So what's happened is that the Chinese are now beginning to export more and more from the likes of Vietnam, Indonesia, etc., into America, and that then is circumventing what's coming to Hong Kong. They're making it in Vietnam, in Indonesia, and then selling straight to the U.S. The parts of the supply chain. So I think that's a very important structural force to be looked at.
And Hong Kong's manufacturing sector, its own manufacturing sector, is quite small, isn't it?
Well,
the city is a conduit, as you're saying, for goods between
Always
China
re-export
and
trade.
the rest
Absolutely.
of the world.
Yes.
I'm glad to hear Enzio referred to our Central Planning Bureau, which is not a joke. They are the ones who publish that data on global trade. It's called the Central Planning Bureau, which we still have.
They're Dutch,
in
aren't
our
they?
capitalistic
Well,
economy.
boo you.
But I just wanted to add one point on that, on these numbers, right? So when exports go down 3% year on year in US dollar terms at a time that, in my very rough estimates, prices are falling about 12 to 15% at the moment, it actually means that in real terms, so if you look at the tonnage or like numbers of containers, we're actually back into positive territory. Like our work looking at seasonally adjusted data on volumes, as in taking out those price increases, suggests that very broadly speaking, in Asia, we have started to see exports bottoming out. They're not racing ahead, but it seems the worst is over.
So that's a good sign then. At least it shows that there is demand there, and it's not so much that it's a Hong Kong sort of problem. It's if anything, it's a global problem.
It's a global problem, and if you look at that data for the big Asian exporting economies, like the manufacturing economies, like Japan, Taiwan, South Korea, China, it's pretty similar, the pattern that you see over there.
Interesting.
Our economy overall, though, it's still pretty sluggish, isn't it? It was 1.5% in the second quarter. There's various campaigns to try and boost it. This Night Vibes campaign to try and get people to go and spend more on the nighttime economy that the Hong Kong government is very keen on. Do you think these initiatives are on the right track?
It's hard to say. I mean, I was out. I went back home at 9:30 yesterday, leaving Central.
And that's what Mr. Chan is complaining about, people like you who are in bed by 9:30.
Well, yes. Actually, it was late for me, but I don't know. I think in principle it makes sense, right? Because many other, if you spend in time in Europe or other places, even Tokyo, there are things going on in the evening, and in Hong Kong, I hear that it was like that as well 20 years ago. Mm-hmm. I don't know when we say that have people changed their habits, or are the people who enjoyed Hong Kong nightlife, have most of them moved away? I don't know.
I mean, I have to say I don't go out after 9:30, but I do have to get up quite early. But I know lots of people now whose evening dining habits have changed. They're now eating earlier because it came about during the pandemic. We were forced to eat earlier, weren't we?
Yeah.
Because everything was closing down now. So people have got used to that and aren't sort of really changing their habits. So
I think during the pandemic, Hong Kong also did its best, I'm sorry to say it, but to kind of destroy the nightlife sector, right?
And a lot of those places have closed down.
Well, like Hong Kong is dead.
Yeah. I mean,
But there's a bit of a displacement going on in that. But I also think that it's this income insecurity. Now, first of all, a lot of people have left Hong Kong. We know that, especially the expats who are very much feeding these sort of happy hour things. But also there's just a lot of income insecurity. Jobs are not, they don't have the stability that they had, Grandpa talking in my day here. So I think that's also putting part of the pajama brigade out of the woodwork.
And of course, the other thing is that people are seeing things like the stock market, which is a pretty bad performer. They're seeing home prices fall. They're not really in the mood to go out and spend a lot at the moment, are they?
Just to play devil's advocate a little bit, all of this is true, but booking restaurants is still not always so easy. I mean, it's not that people don't go out. It's just that they seem to go home earlier. I think in part it's also what is on offer at one's screen or television also matters. I mean, people don't go to the cinema anymore, but they rather just sit at home and watch the movie on the TV screen, right? So it's
structural changes again. Yeah.
Well, restaurants themselves have changed. I mean, if you go out for a meal now and try and eat at 9:30, the waitresses are getting you to eat quickly, and they're getting the breakfast menus out for the next morning.
Yes, absolutely.
It's not so easy to do it anyway now, even if you want to.
It's a little bit of a chicken and egg problem, right? So,
yes.
I mean, I find it laudable. I think it's good that the government looks at it and is trying. But it's going to take a while, probably.
The other problem we have, the base rates here, it's 5.75%. It was left unchanged after the Fed left rates on hold. But how much of this now are we in sort of restrictive territory? There's been a big debate, hasn't there, about what is the neutral rate anyway for interest rates. No one seems to be quite sure, other than it must be higher than what it was before the pandemic.
Well, I'm sure that it's having an effect, but I would also put my hand in the fire and say that we've got to get rid of this 15% property tax, the stamp duty, because that's, and according to some leading politicians here in Hong Kong, that's very much at the heart of why things aren't getting on. So even if you cut rates, the servicing is still quite high relative to one's increasingly insecure income anyway. And on top of that, then if you're still paying this 15% stamp duty for a new flat, well, then there's no incentive to buy.
So what about this relaxation of mortgage rules? The down payments have been eased now, haven't they? If you're a first-time home buyer, you can put just 10% down. Is that going to make a difference?
It'll make a little bit of a difference. It's probably not going to move the needle.
Exactly. Yeah, I'd agree with that.
Okay.
See, again, it's basically, in my simplistic thinking, it's all a function of consumer confidence and income security. And if people have the feel-good effect of a property market rising, the stock market rising, then they will spend. But if they're all a little bit wobbly, as they are worldwide now, on those two psychological factors, behavioral economics basically, then nothing's really going to entice them to go out and shop like crazy and buy flats and all that.
You know, we have a bit of a tough time, right? Because we have U.S. monetary policy, but we don't have the U.S. stock market, and we don't have some of the other
the nice things that go with it.
Yes.
Yeah.
Like
I mean,
guns.
this is an issue, isn't it? As I mentioned earlier in the introduction, I mean, bond yields now, 10-year bond yields, US Treasury yields, 16-year highs. People are starting to feel the squeeze, aren't they now? Because, eventually you have to refinance, and you're going to have to refinance at much higher levels.
Just interestingly, on the U.S., I read recently that 90% of all these mortgages that they're still paying off are actually still fixed. So they're still at 3.6%. So
Yes.
I don't know when that falls due. Do you have any?
In the US?
Yeah, in the U.S. Yeah. Do you have any idea?
The US is a quite distorted market in this sense. Most people have very long-running fixed mortgages.
Yes.
And so that is actually
Absolutely.
the reason why the supply of housing in the US is so low, because everybody is sitting on these mortgages. Nobody is walking away.
And to
Nobody
pay a
is
high
selling their
mortgage.
house.
Absolutely. Yeah.
So no one's going to go and buy a new house
No.
because you will end up having to pay a much higher
Absolutely.
mortgage. So
Yeah.
it ends up with the
So
mortgage.
it is actually quite a distorted market.
But this is unique, isn't it? It's not really. I don't think you really see this anywhere else in the world. It's it's a factor of the US, isn't it? But here we've got this sort of train wreck of a property crisis developing with Evergrande and other mainland developers. We now hear that Evergrande has cancelled its creditor meetings. It's defaulted on a domestic bond. We know that it's trying to restructure its offshore bonds, but it looks like the regulators have stopped that and said it can't issue new debt. How big a problem is this? I mean, clearly we're seeing it here in Hong Kong as well, but obviously on the mainland as well. How big a drag is all of this on the economy?
Well, it definitely doesn't help. It doesn't help in reinstilling confidence among home buyers, right? To me, that's. I don't know all that much about the financial aspects, and I don't hold evergreen bonds. But as somebody who's looking at the home market, and if you look at what's happening to housing sales, the confidence of prospective buyers in China, this is clearly not helping, because people worry that the companies that they need to buy off-shelf their apartment from won't be able to deliver those
Or complete, exactly. Yeah.
It seems to me inconceivable that the regulators are going to not allow Evergrande to refinance itself. That somehow, whatever these rules are, they're going to have to make an exception for Evergrande, or because otherwise the prospect is Evergrande is going to go bankrupt if it can't refinance itself.
Too
There's
big
no
to
way
fail,
it can
too
be.
big to jail. Yeah.
So therefore they're going to have to allow them, aren't they, to refinance, and there's still some time to do that. I think it's got about 28 days before it's formally in default. But if it doesn't, it's the end, isn't it, for Evergrande?
Yeah,
And a disaster for the property market.
Yeah, I think as you say, Peter, probably they will try. Well, I think the authorities will definitely continue to try to make sure that people receive their home, so that these buildings, are constructed. Whether they are willing to bail out foreign bondholders, I'm not sure.
But what about just allowing the company to survive somehow so that it can continue as an ongoing concern? Otherwise, for mainland people, it's going to be a big problem, and for the economy, presumably.
Yeah, so that's why they are making a distinction between, what are the aspects of the company that, for the sake of the economy and for people, need to survive, which is the physical projects on the one hand, and are quite happy to have investors take a haircut when they made risky decisions.
At the same time, it's interesting to note in yesterday's FT that the local investors' greed is prevailing yet again, and they're piling into debt, into credit instruments because of the nice high interest rates, not asking themselves why the coupons are so high on some of these debt instruments. So that's always, but I think it's more of a domestic sort of Japanese-style implosion issue, Louis, not a global, or do you see it as having global ricochet effects?
You mean the
Evergrande?
Well, I think it's definitely affecting the reputation and the vibes around China. Whether they affect people's perceptions of risk in the U.S.
Okay.
It could well be. No, it could well be because China is big, and we have a lot
and
of
the shadow banking
institutional.
System also,
a lot of international institutional players who have been exposed are still exposed, right? So I think it's actually very reasonable what you say, Enzio. Like this must have international repercussions given the size of these exposures.
Yeah.
Do you see similarities between what's happening in China and what happened in Japan starting in the 1990s, and in many ways is still going on? I mean, Japan has never fully resolved its debt crisis, has it? Which came about after its property market collapsed, and it had a much bigger boom than China. Do you see similarities?
I do a little bit. I think that it's a lot of this is, we were just discussing and wondering a little bit, is very much a domestically driven thing, with the caveat that then you do maybe have more of the shadow banks, which also have international tentacles. You have Hong Kong property developers who may have been lured into this, maybe forced into helping to bail out. Then you have the SOE banks, who again have correspondent banking relationships with banks abroad. Surprise, surprise. So there may be a bit more of an international angle than just the Japanese angle that I think was going on in the 90s in Japan.
What about China's economy overall? We've got data coming out at the end of this week. I think it's going to be released on Saturday, the PMI data. Economists are expecting it to tick up, and maybe the manufacturing PMI to return back into expansionary territory. But what do you think? What's your thoughts on, are you seeing us turning the corner on the economy in China?
Well, so we published our outlook 2 days ago about China and the rest of Asia. We see the cyclical weakening of the economy as that big property sector continues to be a very big drag on the economy, but also because of the export weakness and the fact that up until quite recently the government was very stingy in terms of not spending according to its budget. Some of these forces have been turning around a little bit, especially on the government front. In August we saw a pickup in spending for the first time this year. Also in terms of policy more generally, there have been a lot of small measures that the government is using to try to improve confidence. We saw the data improving somewhat on the consumption side, on the investment side, on the industrial production side. As you mentioned, Peter, people expect things to get a little better. I don't expect a runaway recovery at all, but I also don't expect China to fall off a cliff. The authorities, interestingly enough, don't seem to be as alarmed as 1 month, 2 months ago many international observers were. People were screaming for a big fiscal or monetary stimulus. The authorities looked at it and said, we see the economy is weakening. We will take measures to support the housing market. We will try to boost confidence. They are very stingy. They're very frugal in terms of trying to pump money into the economy by fiscal and monetary means. They are looking more at the financial risk side, and I don't see them changing their attitude on that. So we'll just have to accept China may not grow by 5%
absolutely
ever anymore.
But so you think that's the ceiling now?
Also.
That's really become a ceiling for the economy?
I would say trend-wise, I would say potential output growth is not 5 anymore. We may still see a year during our cyclical boom or so, but trend-wise, probably 5% is over.
And you've cut, I think, your growth forecast, haven't you, for China in your latest quarterly outlook?
We cut it to 4.8 for this year and 4.4 for next year.
Right.
I just think if I can add to that, Peter and Louis, that for me the fundamental problem with China is less of the cyclical stuff that's going on, and not that what we've been discussing is only cyclical, but the market is there to serve the state. And that I find very disconcerting. The FT had a very good big read just this week about that, last Friday actually, and they said making markets serve the state's priorities is a big departure from past administrations and the pro-market position initially espoused by Xi after he became party leader in 2012. So tech sectors can't, they say we want to push tech sectors to serve the state. Well, they can't create the employment. The government can't really generate a juicy stock market rally that's going to get the feel-good factor coming back. And then you've got the paltry property sector. Again, people not feeling comfortable with their wealth sort of well-being or mindset. So I think it's very much this market is there to serve the state. I think that's the real problem of China, and that's next to the demographics, slowing productivity growth, foreigners leaving China is also going to weigh on the growth. Exactly what Louis is saying.
How do you get the market? How do they implement that? Get the market to actually serve the states? I'm wondering what sort of measures they're thinking about there.
Like in a way, China's government has been leading development and growth for a long time, right? I think what Enzio means is that it has become more intrusive, and people were really taken aback by what the authorities did with regard to what they call the platform sector, right? The internet sector, and some of the other quite surprising. I mean, it makes perfect sense to look at, is our regulation and are there risks in a certain sector too high, and we need to do something about it. That's totally legitimate. The US is now doing lots of probes against these internet sectors, but it came so sudden, and it came. I think that has really damaged the reputation. Or people are nervous, wondering like, what will the state allow me to do? And
yes. Foreigners also, and that's where this whole Nomura thing is not good, is it? With the Nomura guy being detained in China.
Yeah, these things definitely don't help.
They don't help. No.
That doesn't help Hong Kong's sort of role as a financial centre, because if you're the head of banking here for an international broker, it's going to make you think twice about travelling to mainland China, isn't it? When you hear stories about the head of Nomura's international division being detained in China and told not to leave the mainland.
Totally true. Although, it should be acknowledged that his issue is not related to his tenure at Nomura, right? It is related to his tenure at ICBC.
Yes, sure. But even so, it does make you worried, doesn't it, that you could be travelling on the mainland and could you be arbitrarily detained? It affects Hong Kong, doesn't it? Because we're the sort of the centre, the sort of the international financial centre for China.
Yeah. So, the one country, two systems arrangement, which aspect is more important of those two?
Yes.
It's a big question.
I mean, I'm wondering, is China going to become much more interventionist in its markets? Is that what it's saying when it wants the markets to serve the states? Is that what it's thinking of? I mean, we're seeing it already in terms of IPOs, aren't they? If you want to IPO in the electric vehicle sector or the tech sector, you get approved very quickly. If you're a widget maker, you're not going to get approved.
I think so. And you were saying something before that this is only good. This vice will only tighten in my mind because of Xi's mindset. And I think you were saying, maybe I was misinterpreting you, Peter, but that a lot of the bigwigs in China, they're kind of just towing the line. Well, I think they kind of have to toe the line. I don't think that there's too much wriggle room there, because to Deng Xiaoping's let the free markets do what they will, which is to create 80% of all employment, that's out the window. And I think it's going to really slow things down quite considerably in China.
And what about foreign businesses? I mean, we've seen these reports from the European Chamber of Commerce, from the American Chamber of Commerce. They are very pessimistic about the outlook for China. They're removing investments to other areas. They're urging They're urging the regulatory authorities to try and improve the regulatory environment and make it clearer. I presume when we hear talk about, making the market serve the states, that really isn't going to boost the optimism of foreign businesses.
Can't, by definition. I'm too much of one of von Hayek's last students to welcome this. But Louis, yeah.
Yeah. So I agree. However, if you look at the U.S. Chamber of Commerce in Shanghai and how the answers to the poll to the questions they ask their members, when you worry about China or why are you less optimistic than you were before, the number one reason is U.S. policies with regard to China. I think also it is legitimate for us to complain about many aspects of Chinese policymaking, but when you look at, for instance, making national security issues more important in your overall economic policy setting, where is that coming from, right? We have to acknowledge that China is facing a very different external environment, and it's responding to that. And so many of these aspects are actually responses to things being done by the US and other economies.
Do you see any sign of things improving? We've had the setup of these new financial and economic sort of committees that are going to talk to each other between the US and China. Any sign of things improving?
Well, I think that having been in that game for 15 years backstage in the 80s and 90s, I think the front stage yelling of with this electoral cycle coming up, I call it the wheelchair race actually, because they're both old crooks, but and the backstage selling, in other words, trying to sort of sit down and work things out. I think that the backstage is always more important than the front stage, and that's also where things are really done a lot more, but it's going to be a very, very long slog, and I don't think that but once you get the masses heated up, or the Congress heated up, and I'm sure in China there's also a lot of anti-Americanism, just like in China, in the US there's a lot of anti-Chinese going on, that it's very difficult to quell that. We're not sort of expecting a Kissinger-Nixon 1972 rapprochement anytime at all.
What about the EU, Louis? They're sort of saying they're going to take a stronger attitude towards China as well because of their huge trade deficit, about 400 billion euros at the moment, and they're saying that that's because of unfair practices and subsidies. But Valdis Dombrovskis, who's been in China the last sort of few days, is talking about the EU taking a much more robust attitude. So it's not just the US, is it?
No, it's not just the US, but I just happened to talk to representatives of the EU yesterday. The EU does want it to be known. The EU wants people to realize, yes, we are also becoming, 15 years ago, economic policy was about efficiency, globalization, and how can we improve those things, right? Nowadays, there is much more emphasis on we as a government are going to take interventionist measures to maybe bring production onshore, do all kinds of things. But the EU does want to make the point that we're not like the US. We are. It's still largely about economics, less so about geopolitics or like rivalry between two top dogs. And they continue to repeat. We want to continue to engage with China. We don't want to decouple. So yes, the overall economic landscape in the world is changing, right? Everybody feels they have a mandate to politicize economic policy, and the EU does that too. But I still see an interest to be seen as different from the US.
Do you see that, Enzio? Is the EU maybe a more subtle version of what the US is doing? I mean, it doesn't call it decoupling, does it? It calls it de-risking. That's the phrase that Ursula von der Leyen come up with. Are they being maybe more subtle than the US is?
I think so, but the trade deficit, I'm quite convinced, having written a book on the U.S. trade deficit being a function of the U.S. multinational success in China. I think this must also be the case for the Germans, which is obviously a home base of mine, because a lot of these German cars are actually made in China now. So why export them from Germany? So down goes that chunk of the trade surplus, if Germany even has one with China. I don't know anymore. But I think at least it's cooler heads may prevail in Europe. You must never forget that Europe never had a Buckley versus Vallejo or a Citizens United. In other words, where campaign finance dictates so much of what these politicians, in fact, in many ways, this banana republic is now doing, because it's so much driven by money interests in America that in my day the lobbies were not really on the hill. Now it's just teeming with lobbyists.
Louis, just to wrap things up, you mentioned your quarterly outlook for the Asia-Pacific region. We talked a bit about China. What about the rest of Asia? What do you see there?
Yeah, we see actually quite a bit of resilience in the rest of Asia. We have higher interest rates, we have weak global trade, weak China, but like going around, both in the emerging markets, but even in some of the more developed ones, we see quite a bit of resilience.
Right. And let me just ask you, the rise in both oil prices, the rise in oil prices, first of all, how much is that going to have an impact on the rest of Asia?
Well, it already has. You see already the August inflation data saw a pickup. So yes, we see that impact. And, it's the shock is for what... looking at what has happened on global markets so far, the shock is not going to be as big as what it was 1.5 years ago, but definitely it is a bit an unfortunate event as these central banks had been looking at maybe starting to think about reducing interest rates eventually. Now that the oil and food price increases will delay that.
I just want to also put in something else that many people, and I'm not a monetarist, but many people I think confuse raising the price of money with monetary tightening. And actually, from my very back of the envelope look at these things, it seems as if the US only began reducing its balance sheet only a few months ago, curiously. That's not that tightening in the sense of, in my clock, excess demand for money coming through. That's not quite as pronounced. And indeed, the financial conditions index of the Chicago Fed continues showing easier financial conditions, not tighter, which is all kind of puts the whole thing on its head.
Okay, well, thank you both very much for your thoughts this morning. Good to see you both. You heard there Enzio von Pfeil, who is a capital preservation specialist at Financial Shield, and Louis Kuijs, who is chief Asia Economist at S&P Global Ratings.
Peter Lewis's Money Talk.
I'm joined now by John Beirne, who is vice chair of research at the Asian Development Bank Institute in Tokyo. Good morning, John.
Good morning, Peter. How are you?
I'm very well, thank you. Now, Prime Minister Fumio Kishida has come up with a new economic stimulus plan. I think it includes some tax breaks, doesn't it, for investments, particularly in favoured industries like semiconductors and batteries. But can you tell us a bit more about it?
Yes, that's right. Investment is one of the elements of the new plan. So measures to stimulate investment through different tax measures in key strategic areas. I think this is a very important measure in the current context where, inflows of investment are very important. But that's only one part of the overall set of stimulus measures that were announced. Also, other measures to combat some stickiness in inflation through subsidies on energy, for example, have been announced, as well as measures to stimulate rises in nominal wages, which, as we know, is a key issue in Japan, with real wages continuing to be falling over the past number of many months. And also there are some longer-term structural measures in the package related to demographic factors and dealing with the issues relating to declining population and the aging population as well.
It seems, isn't it, that there's this global trend now to have a more activist industrial policy, particularly in relation to trying to support and stimulate favoured sectors like semiconductors and batteries and electric vehicles. China's doing it, the European Union's doing it, the US has been doing it for a little while now as well with the this Inflation Reduction Act, which of course had nothing to do with inflation, but more about supporting those favoured sectors. Is this where Japan is heading as well?
Well, I think what's important from the perspective of Japan and other economies as well is to seek policy that will enhance the competitiveness of their economies. And this is very important in the current environment where, of course, the external demand and the external environment is problematic. So measures to increase competitiveness in key sectors, including those related to renewable energy, for example, and growth sectors, productive sectors of the future are very important. And this is really underpinning efforts being made in that direction.
And does that include subsidies for companies in those sectors, or providing tax breaks maybe for people who are going to consumers in those sectors, the sort of thing that the EU is complaining about at the moment with China?
Yeah, well, I think that, in order to stimulate a kickstart to these key sectors, there will be some, government support for that, including tax breaks. And this was part of the announcement that was made recently, as we touched on a few minutes ago. So there will be, support for stimulating growth in these key sectors that can enhance potential output in the economy, improve productivity, and improve competitiveness.
Isn't it going to be a race to the bottom if all the big economies around the world are all trying to focus on the same key sectors like semiconductors and batteries and electric vehicles and trying to promote them? All that we're going to get is a massive price war, and margins being very thin, if not negative, for a lot of these companies in the end.
Well, that's one way to look at it. Another way to look at it would be that it would stimulate competition at the international and at the regional level. And this can only be beneficial in terms of efficiency, in terms of passing through prices to consumers, and in the end, in terms of stimulating the pass-through of that activity in the sector towards economic growth that is sustainable over the longer term.
I'm wondering that if Japan will just end up facing the same problems from blocs like the EU that China is at the moment, and you'll end up with complaints from the EU about unfair subsidies to electric vehicle manufacturers and the like.
Well, I think it's uncertain as regards whether there will be complaints coming from elsewhere. I think at the stage of the development of the sector, which is quite in the early stages, it's important to provide support to these types of sectors. If that would carry on into the future, whereby it would be impeding competition and, basically out of line with the international trade order, then that would be problematic, and that would be something to take a look at that stage.
Now, you mentioned another aspect of the Prime Minister's plan is to try and deal with stickiness in inflation that's appearing. Wouldn't the best way to deal with that be for the Bank of Japan to raise interest rates?
Yes, that would be one way to do that. But of course, it's not the objective of the central bank to trigger some downturn in the economy. So at the moment, monetary policy decisions are being driven, of course, by inflation expectations. And what we see at the moment is that although the level of inflation is above target and has been above target for quite some time, there are still concerns around the sustainability of that inflation, with the view being that, the price pressures are largely external, largely supply driven, and would dissipate over some time. Now, there has been an increase in the expected inflation for this year, but moving into 2024 and 2025, it's projected that inflation would converge more towards this 2% level.
I mean, it does have inflation above its target now for, what is it? I think it's been 15 consecutive months or so. But what is it that the Bank of Japan doesn't like about that? It sort of indicates it's the wrong sort of inflation.
Correct, yes. I think, it's not inflation that is driven by domestic demand. It's inflation that's driven by external supply constraints, and well, to some degree at least. And this is why that the Bank of Japan is remaining on hold in terms of monetary policy.
But the Governor Ueda keeps teasing us, doesn't he? Every now and then he says something that makes you think, maybe we're getting towards the end of negative rates. He did that Yomiuri Shimbun interview that said, the BOJ could have sufficient data by the end of this year to determine when it could end negative rates. We all get it, the markets get very excited about it, and then a few days later he walks it back. I'm wondering, does the Bank of Japan, has it got a bit of a communications problem here, do you think? Because the markets are getting mixed messages sometimes.
Yes, I think the markets are sort of jumping on any announcement by the central bank, and then I think certainly clarification and enhanced communication clarity is important as a result of that. I think that the statements made by Governor Ueda were clarified afterwards in the days after the speech made at Osaka. And, I don't think it was the intention to make the signal that there would be an end in negative rates, certainly this year. This year.
So maybe markets and investors in the markets are sort of reading too much into these statements. They're sort of almost looking for any sign, aren't they, that rates could start to rise because it's going to have a significant impact on the markets, and they're sort of over-interpreting Governor Ueda's comments.
That's right. Markets are also looking at the exchange rate implications of continued accommodation in monetary policy. I think that obviously one way to strengthen the yen would be to increase the rates. And markets are not really taking into account the view that inflation is something that could be dissipating over the next months, over the next 6 months and longer, as supply side pressures would dissipate.
So on that, I mean, the Japanese yen now 149 against the dollar. It just keeps on sinking. We had the finance minister saying he's watching market trends with a high sense of urgency, but we're now at the level when the Bank of Japan or the finance ministry last intervened in the markets to try and support it. Are we close to seeing the same thing happening again?
Yes, I mean, as you said, the yen has continued to depreciate strongly. It's close to that level of 150 now, and there is some speculation that there would be an intervention should it get even more close to that 150 level or even beyond. I think that we should not always look at the negative side of the depreciation. It's very helpful in terms of boosting the Japanese stock market, as you're well aware. The weak level of the yen combined with the low cost of financing is one of the factors that's driving the stock market at the moment. On the other hand, the weak yen is, of course, amplifying inflationary pressures. And, I think it will be something that we need to look at closely in the coming days, in fact.
It's also a problem for the government and its image, isn't it, where you keep on seeing your currency just slide and slide. You eventually get to the point where you sort of, as a government, you just can't stomach that anymore. You just can't allow your currency to be trashed in the markets like this. Yes,
but let's remember, this is not something that we expected at all. Like, the yen is strongly driven by what's happening in the US, and persistence in inflation in the US and longer than expected tightening in the US is a factor behind that, as well as more recently we have seen oil prices go beyond $90 per barrel, which is the highest level they've been at since just after the Russian invasion of Ukraine. So all of these external factors are driving the yen situation, and obviously domestic factors are somewhat at play as well. But I think that the external side we did not expect to carry on for this long.
But I mean, I wonder why the government is so surprised if it really is. I mean, it tries to make out that this is abnormal and not in line with fundamentals, but it's perfectly normal what's going on, isn't it? Because you've got the US 10-year Treasury yield now at 4.6%, a 16-year high, and the 10-year Japanese government bond at about 0.75%. So it should be no surprise at all to anyone, really, should it, that the yen is sliding?
No, absolutely. There's no surprise because, if we believe that the fundamental is the yield spread between the US and Japan, then, a depreciating yen is what we would expect. What we did not expect was that the yield differential between the US and Japan would persist for so long. And this is looking like it will stay in place for a little bit longer than we would have expected even last month.
I mean, this is the problem for everyone globally. I mean, it's happening in Europe as well with the Bund yields, the UK gilt yields. That US Treasury bond yields are just rising far more than anyone expected to sort of multi-year highs, multi-decade highs almost now, and it's having fundamental implications for economies everywhere and financial flows.
Yeah, I think it's very clear that getting over the inflation hurdle is very difficult, certainly as one gets closer to that target level. What's also important to remember is that I don't think we did not expect the tightening cycle to last this long. But even if rates would pause in the US or other advanced economies, I think it's quite clear that they will remain at a high level for some time. So this will be a factor that is, going to impinge upon the level of the yen, certainly in the near term.
Well, and the markets then still haven't got it right, have they? Because the Fed made it very clear last week in its dot plot that the most they're expecting is 2 rate cuts next year. The markets at the beginning of the year were expecting at least 5 rate cuts, 5 quarter-of-a-point rate cuts. They're still expecting around 4, so they're still out of line with what the Fed is saying.
Yeah, I think it's very difficult to get full alignment between the central bank and the market expectations in the US or anywhere. But I think that, data-driven policy is obviously something that will, necessitate a change in a view over a period of time. And this is what we are seeing at the moment. Of course, the expectation at the beginning of the year is different to the expectation now because data has changed in terms of the outlook for the economy in the US, the tightness in the labor market. All of these factors are contributing to what we're seeing at the moment with, a less likely softening or a less likely lowering in rates in the US over the next few months and into 2024.
And this is the message that markets are starting to get, and they don't seem to like very much, looking at the way global equities are moving in the last few days, and that is rates are staying higher, and they're staying high for longer.
Yes, exactly. Rates are staying higher until, the data indicates that we are moving closer towards the inflation target, but not only that, in a sustainable way, and also balanced against not triggering a recession in the economy. And that's the key point here. Mm-hmm. How to move monetary policy in a manner which brings us towards inflation in a sustainable way without triggering a recession.
Okay, John, well, it's always a pleasure talking to you. Thank you very much indeed. That's John Beirne, who is Vice Chair of Research at the Asian Development Bank Institute over in Tokyo.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with this show. I'll be back tomorrow when my guests will be Andrew Ferris, the CEO of Econosis Advisory, and William Ma, Chief Investment Officer at Grow Investment Group. And with a view from Singapore is Jeff Howie, Market Strategist at the Singapore Exchange. Please catch me tomorrow.
Money Talk.